Okay, so we outlined this critical area, very obvious. We gapped up, we then completely sold all the way down. Let's extend this prior area of support. Let's see if we tagged it. Well, there you have it. We're pretty much exactly at that level. So what do we look for now? This move is pretty decisive. It's very large, very strong, very big move. So I would not be surprised to see some attempts, some small attempts. Either we gap up to start the day tomorrow and then continue to sell, or potentially try to rally early in the day and then reverse back down. Why? Well, we have 439.5. It will now yet again act as resistance. It acted as support here once we broke through it. It acted as resistance once we broke through it again. It will act as resistance again. Welcome back, you legends. I'm Dr. Kyle, and today I want to start with the 1 hour chart. This is the S&P 500, and let's talk about what happened Friday. What exactly happened Friday? Well, on Thursday, we had that bearish engulfing candle. We opened above the highs, closed below the lows. And on Friday, we had Jackson Hole at 10 a.m. Eastern Time. As soon as Jay Powell began his speech, we had this rally, attempted rally in the morning, fizzle out completely and reject all the way down, creating this tombstone bearish candle. That candle was followed up by a hammer candle, essentially creating this huge indecision candle on the 2 hour chart. Here it is, very large indecision candle on the 2 hour chart, followed by a rally to the top end of the chart, and then we parked exactly at that level of resistance at 439.5. In fact, I talked exactly about what I called the pocket. And here's the pocket on the 1 hour chart. This is the pocket that I discussed. It's the range between 441 and 439.5. An attempted rally is likely to fail in this pocket and get rejected. That's exactly what happened to start the day. The market rallied to start the day, cleared 439.5, rallied all the way to 441.19. Exactly at the pocket, exactly in the pocket, got rejected, continued down, and intraday on the 1 hour chart, in the second trading hour, we actually traded below what I call the last line of defense for the bulls, and it's this trend line. Now, had this trend line broke on the second trading hour, the market would have easily continued down to 431 by early next week. Now, something exceptionally interesting happened. We did not close below it. So the bears had the perfect bearish setup to start the day. They had that bearish engulfing candle the day prior. The market had that attempted rally to start the day exactly as we expected. It failed exactly inside the pocket that we wanted it to fail at, where you would expect the rally to fail to complete this head and shoulders pattern on the 1 hour chart. But then that second 1 hour candle closed just above that key support line. As it broke through it intraday, it got rescued. And from that point on, the market moved sideways for a bit. It had that breakout just before the market closed, and then it retraced back to that key level again, 439, and it parked right above it. So from a market psychology point of view, we had that bearish engulfing candle. Here it is on the daily chart. Perfect bearish engulfing candle, rejected exactly at the level that the bears wanted it to reject, 444. Produced an exceptionally bearish candle above average volume, closed below yesterday's open. In fact, erased 3 days. Look at that. Entire week of trading completely erased in 1 day. And then the next day, we had another bearish catalyst, and that was Jackson Hole. And the Fed came out yet again. Jay Powell reaffirmed the higher for longer stance, talking about the potential for even higher rates. In fact, the Fed Watch tool shows that odds of a rate hike in November went up from 40% to 50% by the end of the day. So the market had even more conviction that the Fed was going to raise rates once more this year by November. Not necessarily by September, but by November. 1, we had that bearish engulfing candle. 2, it rejected at a key zone. 3, we had that failed rally attempt to start the day. 4, it happened on a key fundamental news event, Jackson Hole. And then it failed to produce a close below this key trend line. So the bears had all of these tailwinds stacked in their favor, and they did not see follow through to the downside. That has to give us pause about the thesis of a double bottom with a lower low to 431. Remember, this is 433. 431 is this gap fill level from the prior lows in June. This would create the perfect gap fill, and it would reconnect with this neckline of this large potential head and shoulders formation that's forming. And remember, we had 4 reasons stacked in favor of this area, and then the sellers did not commit and the buyers stepped in at a higher low. If you have all of these tailwinds stacked in your favor and you don't end up with a key break after that perfect bearish setup, perfect rejection on the daily chart, bearish engulfing candle, Jackson Hole, sell off to start the day, rejection at 441, that pocket that I discussed in the trading community. By the way, guys, this is what the trading community looks like. I post daily live analysis. I post all of my trades and investments in the trading community. I post weekly trade setups and weekly watch list with the weekly expected moves for more than a dozen different stocks and the 3 major indices. If you'd like to support the channel, you can slap that like button right in the face. And if you want to have access to all of this cool stuff in the trading community, check out the link in the description below or visit our Patreon page at patreon.com/moneytimemachine to take advantage of all of that good stuff. Now back to the 1 hour chart. Let's clean this up very quickly. What happened here was a speed bump. This is a speed bump. Sellers pinned the pedal to the metal, sell, 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 sell. Then they hit the speed bump and boom, boom, we went back up. Initially rejected, went back down, boom, we went back up. So if we did not have commitment from the sellers, that's a key data point that we have to take into account in our analysis, and we have to put that in our balance of probabilities, stock market, and assessment. Okay, so this is 1 day of trading. This is 1 day of trading. 1 data point is not significant enough. We need to see follow through now. We absolutely need to see follow through from the bulls. If we get a close above this candle, anywhere above this candle, I would call that a confirmation to the bullish side. Why would I do that? Why? Well, because the bears had that perfect setup and they failed to produce follow through to the downside. Now, we cannot say that they completely failed because this is just 1 single day. That's just 1 day. So we need to see follow through to that day on Monday. If we get bullish follow through on Monday, this will likely be the beginning of a second bounce. Right, this is the first bounce, and if this low holds, this is likely the beginning of a second bounce. Yes, it's just 1 trading day, but based on that, 4 tailwinds to the seller's side, no follow through, huge volume. Look at this, even larger than the volume on August the 18th. Bigger volume, green hammer candle, higher low. All of that is important. We cannot ignore any of that. Yes, this is a huge bearish engulfing candle, and yes, it's very common to retrace back to the middle of the candle. In fact, that's exactly what I talked about. The 50% retracement level is at 441. We hit that. We hit that twice on Friday, twice. At the beginning of the day, rejected, then came back and sat just at that level, again rejected. Look at this. We have 2 rejections, 1 huge rejection, 1 small rejection. The second rejection sat on top of that key resistance level of 439.5. And another key development is the close above the 5-day moving average. This gray moving average is the 5-day moving average. It's the trend setting moving average. Whenever price is above it, the market is in a short-term uptrend. Whenever price is below it or is rejecting at that level, the market is in a short-term downtrend. So bears had all of those technical setups, fundamental catalysts in their pockets, and then they did not manage to get that close below this trend line. Now the stochastic has produced a bullish cross. Price is above the 5-day moving average. It did produce a bullish hammer candle. It did produce a higher low. All of that has to be taken seriously. It has to be taken seriously. The second step the bulls need is a close above the 9-day moving average, this descending orange line. Just a close above it by Monday would be the second arrow in their quiver. The third and final, I would say, nail in the bearish coffin is a close above the 5-day moving average. Any close, honestly, above the 50-day moving average. Any close now above 444 opens the door for even higher moves all the way to this neckline at 451, this area here. That's if the bulls manage to pull it through and produce two key developments, a close above the 9-day and a close above the 50-day. Now, if they fail to do that, if they rally and then again fail to do that, that opens the door to 431. So we're now at a key moment in the bear bull pull. It's a battle going on. Bears don't have a lot of time left, right? Momentum is beginning to shift towards the bullish side. We have the PPO histogram slowly producing smaller and smaller bearish candles. Eventually, it will produce a bullish cross. If bulls manage to hold this level, the RSI is now making higher lows. The 1-hour chart is now making higher lows after making lower lows. We have a close above the 5-day moving average after a key fundamental news event, Jackson Hole, and it all happened on large volume. So as of the close of Friday, momentum is now beginning to shift from the bearish side to the bullish side. In fact, let's take a look at the stock market map. This is the weekly performance for last week. Notice the biggest gainers last week were cyclicals, right? We had Tesla, technology, we had Microsoft, Apple, and Google, and semiconductors, we had Nvidia, and we had software names also rallying off the back of yields potentially topping. Now, this is so important, guys. Now, yields and the dollar are the second major reason besides the switch of momentum that we just talked about, that we just covered. That's the second major reason that the bears are running out of time. The bears had their opportunity Friday to keep going lower to hit 431 by Tuesday. Remember, we had our target by Tuesday. Why? Well, because stock market seasonality tends to indicate that we get the second dip in August by the 19th and 20th trading days. If we measure that with our timing tool, here it is. Friday was the 18th trading day, the 18th bar. Monday's the 19th trading day. So we had between Monday and Tuesday for the bears to push it lower to 431 to put in that double bottom with a lower low on the daily chart and a higher low on the momentum. So we were looking for a double bottom with a lower low and a bullish divergence and for a rally to start. It is possible that the double bottom has actually developed Friday, and Friday was the double bottom, and it ended up producing a double bottom with a higher low instead of a lower low, and it produced what is called a hidden bullish divergence. So what is a hidden bullish divergence? In terms of bullish divergences, we have two versions. The first version is we make a low followed by a lower low, and on momentum, we make a low followed by a higher low. Now, that is a classical bullish divergence, and that's what I was looking for because that's the most common setup for divergences. There's a second way divergence can develop, and it's called a hidden divergence. A hidden divergence, legends, is when the market makes a low followed by a higher low while the momentum makes a low followed by a lower low. This is called a hidden divergence. When you get the divergence with the lower low in the momentum indicators and not in the price action. This is less common. This is way more rare, I would say, but it did happen recently. When? Well, it happened right here on the March bottom, March 13th. What happened on March 13th? Well, we had a hidden bullish divergence. Where's the divergence? Well, price made a higher low versus the low in December, while momentum indicators like the RSI, look at that, they made a lower low. And the PPO, look at this, very close, almost an identical low, very slightly lower, okay? So we had that bullish divergence on the RSI, almost there on the PPO. I would say it was there on the PPO. And recently, what do we have? We have higher lows versus these lows back in June. And again, on the RSI, look at that, lower low, PPO, significantly lower low. So if price ends up again closing above the 9-day, then recovering the 50-day, this will confirm this hidden bullish divergence. Now they're called hidden bullish divergences because they're very sneaky. They're rare. They don't always happen. They get missed quite often by technical analysts, and intuitively they don't always make sense. So again, we had cyclicals, we had tech all leading last week. Look at that, cyclicals, technology leading. That's risk on behavior. That's the market participating in risky behavior, buying risky assets, dumping consumer defensives. Look at that. They're switching away from defensive posturing into offensive risk on behavior. That only happens if the market is turning bullish. Now, let's look at the weekly chart because that's important. What's happening on the weekly? Well, the weekly completed a mean reversion all the way back down to the 50-week moving average, which is, the 20-week moving average, which is the 100-day moving average. It's this yellow line right here. It completed that back test the week prior. Last week we had the first green candle. It is an inside candle, right? It did not go through either to the upside or to the downside relative to the candle prior to it. So it's an inside candle. It is an indecision candle. It has a long wick to the upside and a long tail to the downside. Has a small body. That body is green, which tends to lean slightly bullish. And if the market manages to clear this high, this prior weekly high next week, that definitely opens the door for a rally higher. Now, in contrast, if next week's candle closes below this week's candle, that opens the door for lower lows. Now, but again, remember guys, the bears had that perfect setup, bearish engulfing candle, perfect fundamental catalyst, perfect news catalyst. They did not have that follow through selling. And on top of that, now the bulls are getting two new tailwinds. So the bears are running out of time. Those tailwinds are, look at this, 10-year yield, it's topping. I talked about the 10-year yield last week. It is topping. At that decisive break below the 5-day and the 9-day moving averages, it is now forming this bear flag, and it will almost certainly continue to the downside. PPO produced a bearish cross. And if we take a look at the dollar index, look at this, guys, similar look. This now looks like a fake out breakout. Why? Well, because we broke above this resistance line in this channel, and then we produced this indecision candle. What does that look like? It looks like this. Look at that, fake out breakout. Swipe these prior highs, make a new high, produce an indecision candle, follow through to the downside. The next trading session will confirm that the dollar has topped. If that happens, if we get confirmation that the dollar has topped, we put that with the 10-year yield topping, that will mean valuation expansion on all stocks. So stock valuations will expand, and that's exactly why you had those software names rallying last week. Why? Well, software names have the highest multiples. They have the highest valuations of anything in the market because they grow at the fastest rates. And so they are the most interest rate sensitive assets in the stock market. That means when yields move down, these like to rally. When yields move up, these like to get crushed. And now that yields are topping, these should now begin to see some significant rallies. Now let's talk about the NASDAQ 100, the triple Qs. Look at that. It continues to hug this support line, or I should say trend line. This trend line marked both the December, January bottom and the March bottom of this year. We had an initial break Friday 2 weeks ago. We had another initial break last week toward the end of the week. Then we ended up with a rescue operation and we rescued that trend line. Volume is above average, huge volume on a small bodied candle. PPO is flattening. Look at that. PPO is flattening. The histogram is rising. So again, bears are running out of time. They need to get a breakdown early next week for this sell-off to continue. If they don't manage to get that, again, that opens the door for a rally all the way up to this neckline. This neckline is at 375 on the NASDAQ, and it's at 451 on the S&P 500. What about the Dow Jones? Look at that. Dow Jones tagged this support line, trend line again. Perfect tag. And so far it held. If it continues to hold, it will prove to be another bottom. What about the Russell 2000? Well, look at the Russell 2000. It produced that double bottom with a lower low on the daily chart. If I put on the 1 hour chart, look at that. Lower low on the daily chart, higher low on the PPO. Now, this is the bullish divergence that I was looking for on the S&P. This is exactly the kind of setup that I was hoping for, because it would be a very clear cut and it would highly indicate that the bottom was in. We ended up with a higher low Friday, so a little bit of a more sneaky setup, and it honestly keeps the door open for moves in either direction in the short term. I believe that within 3 to 4 trading sessions, we will have established the bottom, whether it is this Friday or a slightly lower low. I think within 3 to 4 trading sessions, that will happen. Why? Well, because again, bears are running out of bearish catalysts, and the dollar and the 10-year yields are both showing signs of topping. And that will be a tailwind for higher valuations. That would mean a continuation to the upside, a rally. Let's talk about the VIX. Well, the VIX has produced a bearish cross. It failed to produce follow through to the upside. Unfortunately, the VIX has put on one of the trickiest candlestick structures, and it's this. We had a bullish engulfing candle. We had a huge decline the next day, but that huge decline did not close below yesterday's low. So far, this is just a pullback in the VIX for confirmation for a breakdown in volatility. And by the way, guys, any rally in the market will absolutely 100% need the VIX to break down. For a breakdown, we absolutely need the VIX to close below this low, and that's at 15.55. We need to close below 15.55. That will confirm this breakdown. Otherwise, this remains just a pullback in volatility and does not necessarily mean that the VIX has topped just yet. We need to see the price action for one additional day to know how this setup is going to resolve. Okay, let's talk about the Dow Jones Dow theory model. Up top is the Dow Jones Industrials. Down below is the Dow Jones Transports. As of Friday, we do have a bullish divergence. Transports tend to lead the market when they establish a bullish divergence, i.e., they made a higher low, versus the industrials that tends to establish the bottom. That tends to establish the bottom, right? Transports higher low, that established this bottom, as the industrials put in a lower low. Again, transports higher low, industrials lower low, established the bottom. Again, transports significantly higher low, industrials basically equal low, that established the bottom. And again, we have another bullish divergence, which tells us that a bottom is near, if not has already occurred. High yield bonds up top, S&P 500 down below. This is what we call the smart money. The smart money is 1 day away from putting on a bullish cross, which is a buy signal. Number 2, we have this huge, massive bullish divergence. The smart money has put in a higher low versus this low back in July. The S&P 500 put in a lower low. This is a huge bullish divergence because it lasted for quite a long while. And on top of that, we have here very clear bull flag. So the smart money is now actually flagging. This bull flag could break to the downside. It is still absolutely possible, but it has to happen in the next 2 to 3 trading sessions max. If it does not occur within the next 3 trading sessions, this bull flag will resolve to the upside. In fact, if we get a breakout on Monday, it will confirm that this bull flag has broken up to the upside, and it will likely confirm that the bottom has already been established. XLY divided by XLP. In any stock market rally, you want to see consumer discretionary, XLY, outperforming XLP, consumer staples. We've began to see that, as I outlined in the weekly relative performance. Cyclicals outperforming defensives. Cyclicals are the consumer discretionaries. There you have it. We have a bull pennant. This is that chart, relative chart. We have a bull pennant. It broke to the upside last week. It back tested the upper edge of that pennant. And so far, guys, it looks like a major breakout is about to happen in discretionaries, especially if I look at Tesla. Look at that. This is Tesla. We had a rally to the upside. Then we had this bull flag develop. We got nowhere near this prior low, this Monday low. Can we go back to form a double bottom? Yes, absolutely. But if we get a close above this high, this 241 high, that will establish a bull flag breakout, and a bull flag breakout will produce a full measured move all the way up to, let's see, 257. That means the 50-day moving average on Tesla. Now let's talk about the most important chart today, the absolutely most important chart, and it's the CPC buy and sell signal. This is the put to call ratio buy and sell signal. When do we have a buy signal? When we cross above 1.1, come back down and produce a cross down on the PPO that establishes the end of put buying and the beginning of call buying, and it called every single bottom pretty much in the last 12 months, okay? Every single one. Has it produced a buy signal yet? No, not yet. It hasn't yet produced a buy signal. It could potentially produce one within the next several trading days. We could potentially be at the beginning of a new uptrend, but so far the PC and the CPC has not yet produced a buy signal. This tends to be a slightly lagging indicator. It tends to confirm the bottom about 5 to 6 trading sessions in the future. Look at that. It came after the market bottomed about 5 days earlier. Same thing here, guys. In this example, in a bear market downtrend, it actually tends to call the bottom almost perfectly. In this example, it called this double bottom. In this example, it called the bottom exactly 1 day after it happened. In this example, again, it called the bottom exactly 1 day after it happened. So far, no buy signal. The bulls need the CPC to produce a buy signal for a new uptrend. Same thing on the summation index and same thing on the NASDAQ summation index. Both the NYSE and the NASDAQ summation indices have not produced buy signals, not there quite yet. They need first the oscillator to produce a green signal and for the summation index to produce a bullish cross. Neither of those have happened. We don't even have a bullish divergence yet. That means we have to be patient. Again, Friday was just one data point. We need to see follow through either to the upside or to the downside by Monday and Tuesday. And based on seasonality, yet again, guys, 19th and 20th trading days. That means Monday, Tuesday, next Monday, and next Tuesday. That's when, seasonally speaking, where we get the bottom. Let's talk about the fear and greed index. We're still at fear. Look at this, guys. 48, we came just above fear, still below neutral. Stock market momentum showing greed, price strength neutral, price breadth actually showing fear. Breadth has declined significantly. Put to call ratio, look at this. Huge turn. Very big turn, but not there yet in terms of a buy signal. Getting close, not there yet. Market volatility has this double top. It needs one follow through day to the downside to confirm the breakdown. It needs to break below 15 and a half. If that happens, we get a close below that. We will likely continue to move down and even take out the 50-day moving average. Whenever volatility is below the 50-day moving average, that's when the market is in an uptrend. Anytime we're above the 50-day moving average, the market is in a massive downtrend. Here it is. Let me add the S&P so you guys can see what I'm talking about. Let me highlight these times, right? Anytime we're above the 50, the market is declining. Anytime we're above the 50, the market is declining. Anytime we're above the 50, the market is declining. Boom, anytime we're above the 50, the market is declining. Anytime we're above the 50, the market is declining. So we need it to move back below the 50-day moving average. Anytime we're below the 50-day moving average, the market is rallying. In terms of economic events, next week we have the JOLTS job openings Tuesday. That's going to be an important number to look at. And we have the PCE on Thursday. Friday, we have the unemployment rate. So Thursday, Friday, key economic drops. These 2 days, expect huge moves on these 2 days. If we get a bullish cross on the PPO and we get positive reactions to the PCE number and the unemployment rate, that will likely put an end to the medium-term downtrend, and we should see roughly a 2-week rally to go back to 451 on the S&P 500, potentially even higher, but we'll talk about that when we get there, and that still leaves the door open for more downside in October. Remember, guys, seasonality tends to be quite negative in pre-election years in the second half of October. September tends to be fine. We tend to rally in the first half of September. Then we get that dip. Market tends to top in the middle of September. Get that dip. Get a rally again in early October. Put in that double top and then get a severe sell-off towards the middle of October all the way into early November. So again, something like this makes sense rally a couple of weeks in September, put in a top, come back down, rally again in October, maybe put in another top. So guys, we could very well be establishing a range bound market. Again, guys, look at seasonality, range bound all the way into holiday season, just before December. That's when the market tends to rip to the upside in pre-election years. If you enjoyed this video, slap that like button right in the face. If you watched till the end and you did not enjoy the video, I thank you for your time and attention. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.